Our guest today is Mr. Rajeev Thakkar, Chief Investment Officer, Parag of PPFAS Mutual Fund. He is also the fund manager in charge of Parag Parik Flexi Cap Fund, a fund that is currently rated 5-star by both Morningstar and Value Research. This fund has given investors a compounded annual return of 18.7% over the past 5 years. This is in no small measure because of the fund's investments in several US technology giants. In this interview with Business Standard, Mr. Thakkar explains the ongoing turbulence and downturn in the US technology sector and how retail investors in India should respond to it. He also offered his perspective on the existing restrictions on foreign investments via the mutual fund route. Indians today have a lot of exposure to the US market and especially to the US tech sector. In recent days, the US tech sector has seen a lot of downturn. Why is this happening?
So what has happened in the overall economic environment in the past few months is that inflation has shot up the world over, and consequently central banks are in a tightening mode in terms of reducing liquidity and increasing interest rates and things like that. So in the tech sector, there is a mix of companies. There is at one end the companies which are older companies which have established revenue models, which have established profitability, and at the other end there are these companies where the product or the idea may seem promising, but they are currently in the cash burn stage where either they are spending a lot of money on advertising or incentives to get customers, or they are spending money on R&D or on developing their technology, and they are currently loss making, or as is called in the cash burn stage. So in a era of rising interest rates, in a era of costly money, the funding for some of these companies has come under question, and investors are looking at uh, the path ahead for these companies, whereby they have to uh, get their unit economics right, and where they have to prove that they have profitability to get the trust of the investor. So what has happened is both set of companies have seen a dip in prices, but the more established companies have maybe fallen about 25-30% from the peak levels that we saw, whereas some of the uh, loss-making companies have seen falls in excess of 50%, in some cases in excess of 75% as well. Uh, this is not unlike what some people would expect. This is not something which is unusual in the tech space. So, if you look at the past 15, 20-year history of well-known companies like Apple, Microsoft, or Amazon, you have seen these companies falling uh, around 30%, 40%, many a times whenever the sentiment is turned adverse and things like that.
So you're saying that this kind of a fall should be accepted by retail investors. What is the advice to them? Because a lot of them are quite worried about their foreign exposure. And also one tends to see that whenever the market sentiment turns poor, people tend to pull back to their home base. What would your advice to these investors be?
Sure. So one should not be at the two extremes in terms of their investment allocation. So never go and say that this is the only sector and this is the only country where I will put all my money in. So just redeem everything and just buy a handful of companies or one particular mutual fund with a particular theme or something like that. That should not be done. At the same time, saying that, oh, all this is seeming very, very risky, and I'll redeem whatever I have and I'll only invest in my own home country, that also doesn't work. What happens is when you have multiple country exposure, at some point in time, some country may be doing well, at some other point, some other country may be doing well. So that gives you geographical diversification, as well as in terms of sectoral diversification. For example, currently tech stocks are beaten down. Currently, energy stocks are doing well because of shortage of crude oil or coal or something like that. Uh, if you go back to, let's say, uh, maybe April, May, June of 2020, at that time, briefly on the exchanges, crude oil futures had traded at a negative value as well, and oil was down and out. And at that time, people were thinking that in the work from home environment or in the lockdown kind of environment, tech companies will do very, very well. So that time there was a rotation into tech stocks. So one should not fall prey to either of the extremes. And one should have a well diversified portfolio where uh, profitable tech stocks should find a place in people's portfolios.
So, what is happening about the restrictions in related to foreign investments through the mutual fund route? If you could tell us what is permitted today, what is not permitted.
So there are two limits which are there, which govern the investments by Indian mutual funds in foreign securities. One is the general limit of $7 billion for the entire mutual fund space, which is close to being hit or which has been hit. So because of which SEBI is not permitting funds to invest incremental money abroad. What this means is mutual funds can buy and sell foreign securities for the same dollar value, or they can reinvest the dividends that they've received in dollar terms, but they cannot remit more money outside of India by converting rupees to dollars. So that limit has been hit. So almost all fund houses are not incrementally buying foreign securities. There is an additional $1 billion limit for funds which invest in foreign ETFs. This limit apparently still has some small leeway, and via this route, some funds are investing in ETFs abroad, to my understanding. But broadly, the limits are close to being hit or have already been hit, and not any meaningful amounts are not being invested abroad now. So, and this situation will continue till the time RBI and SEBI increase this limit sometime in the future.
So you had restricted investments by retail investors into Parag Parikh Flexi Cap Fund. Then you reopened it. So how is the money being channelized currently? Where is it being invested? Only domestically? Or?
Yes. So incremental money will be only invested in domestic stocks. The existing investments stay as they are. So that is not affected. So we cannot remit more money out of India to buy dollars and hence buy foreign securities.
Why has this restriction gone on for so long? One expected initially when it had happened, one had expected it to be lifted quite quickly.
So nothing has been put out in terms of official communication by RBI on this. So one can only uh, make guesses about why the situation is as it is. Uh, One of the factors has been that foreign portfolio investors have been redeeming their investments or have been selling Indian stocks for quite a few months now. So there has been a capital outflow scenario from India. Uh, our import basket is expensive right now. So in terms of the oil prices and so on, so energy costs are high, and overall in our neighborhood, for example, Sri Lanka is going through its own financial crisis and things like that. So at such a point in time, maybe the feeling is this is not an opportune moment to increase the limits, and they may be waiting for a more calm period where the balance of payments and energy prices and inflation and capital flows and everything is more or less stable. Given the uh, COVID uncertainties of the past and the recovery phase right now, Russia-Ukraine war, capital outflows, increased oil prices, and all of that, given the macro situation, I think there may be more deliberation in terms of increasing the limits. This is again my guess. There is no official communication, neither do I have any insights which are different from the general public.
I think I've finished with my questions, sir. Thank you so much. It was a pleasure speaking to
Thanks.
you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.